Welcome back, friends. So, we had the Federal Reserve meeting conclude yesterday, and we had Jay Powell, the Fed chairman, hinting at uh, interest rate reduction at the September FOMC meeting. But the traders on Wall Street seem to be getting impatient and really impatient. What is it that they are looking for, really speaking? The bar is getting set pretty high, and that really doesn't make a lot of sense. The Fed needs to start that process back gradually to normal, which means gradually reducing interest rates. So we have Claudia Sahm, the chief economist at New Century Advisors, talking about her own benchmark for where the Federal Reserve should be concerned. Known for formulating the Sahm rule that uses changes in the inflation rate to gauge when the recessions occur, Sahm has been clamoring for the central bank to start easing monetary policy so it doesn't drag the economy into recession. The Sahm rule, so as to say, states that when the 3-month average of the unemployment rate is half a percentage point above the 12-month low, then the economy is getting into a recession. Okay, so when the 3-month average of the unemployment rate is half a percentage above its 12-month low, be careful. The 4.1% jobless level is only a short distance from triggering the Sahm rule. And Sahm said that Fed's insistence on holding short-term interest rates at their highest level in 23 years is beginning to endanger the economy. So there's a talk that we don't need a weak economy to get that last little bit out of inflation. We do not have to be afraid of a good economy. If the inflation job is done or we are on the glide path, it's okay, the Fed can start stepping aside. Now, asked about the Sahm rule during his post-meeting press conference yesterday, Fed Chairman Jay Powell called it a statistical regularity that doesn't necessarily hold true this time around, as the jobs picture remains particularly strong and as the pace of wage gains decelerates. What it looks like is a normalizing labor market, job creation, and a pretty decent level of wages going up at a strong level but coming down gradually as well. If it turns out to show something more than that, then the Fed Chairman Jay Powell said that we are well positioned to respond. Markets, though, are pricing in an aggressive path for rate cuts starting in September with a quarter percentage point reduction, which would be the first since the early days of the COVID crisis. After that, the markets expect cuts in November and December as well, with an about 11% probability assigned to the equivalent of a full percentage point lopped off the Fed funds rate by year end. According to the CME Group's FedWatch gauge of 30-day Fed funds futures contracts. Instead of starting to take its foot off the brake, the Fed on Wednesday said that it is keeping its overnight borrowing rate in a range of 5.25 to 5%. The post-meeting statement did note good progress made on the inflation front, but also reiterated that the policymakers on the rate-setting Federal Open Market Committee, or FOMC as it is popularly called, need greater confidence that inflation is heading back to 2% before they are ready to lower interest rates. That's exactly what one can think, because one can see that all the other underlying aspects of employment data are not improving, they are deteriorating. So once it starts to get to that upper level where they have to start cutting interest rates, it's going to be more than one can normally think. The Fed could end up slashing rates by a good amount, say 150 basis points over the next year, a pace that's more aggressive than the policymakers charted when they last updated the dot plot of individual projections. The consumer price index will be below 3% soon, making real rates or the difference with the Fed funds rate particularly high. If you have a positive real interest rate that's even 1.5%, then that would suggest that you have 150 basis points of room to cut interest rates without even thinking that you are being excessive about it. Okay. However, do keep in mind that there are rising geopolitical tensions, particularly in the Middle East, and the jab in Russia, Ukraine does not seem to have been come to any conclusion. Middle East particularly does seem to be now, in fact, gathering more pace, and it's nowhere near to fruition. So I think in such a scenario, whenever you have war-like situations prevailing in many parts of the world, the commodity prices like oil and other commodities to come down in a jiffy way may be rather difficult. The effects of these rising geopolitical risks can be felt, or if not immediately, but over the next few months as we go further. So if we are looking at the Federal Reserve, looking at its September, then the November and December meetings, they will also have to deal with these rising commodity prices, which can also have an impact of inflation and can slow down the rate of interest rate cuts that most people on Wall Street are beginning to imagine. If this was to happen, then you can see that the markets can get a good beating, because there could be expectations of a quick cut in interest rates consistently, whereas if inflation turns out to be stickier than anticipated, then that could mean that the central banks across the world will be loath to cut interest rates as quickly as imagined. In such a difficult scenario, friends, to hold an exceptionally optimistic view of the markets is going to be a little bit of a dilemma. It's not going to happen the way people desire, and right now the very aggressive expectations of interest rate cuts may not actually happen the way it is planned for. Friends, so we have our views of the market, including the point of time where the geopolitical tensions and the inflation can rear its ugly head once again. Do join our Prime or Prime Plus groups, which are addressed specifically for the US financial markets, so you can get to know where the markets are headed from here over the next few weeks, few months and years. And yes, you can do that by WhatsApping us on 982-086-1044. Alternatively, you may also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. So friends, have a great investing day ahead and wait out. The next few months are going to present excellent opportunities, but not exactly in the way the street is anticipating at this point of time. We have our own views and we would love to share them with you. Do join our Prime or Prime Plus groups and you'll be a beneficiary of some fantastic advice. Happy investing. Take care. Have a great day ahead.